Diamond Index that you're looking at, it is up 2%. Hang Seng is up almost 0.7%.
Internals of the GDP, it's been dragged down terribly by mining and manufacturing.
The growth fell to the 5% handle. That 66% of companies on the NSE 200 which have reported have seen earnings cuts. It's the largest downgrade since 2020.
After it starts off in the red, let's see whether or not there's a recovery.
Auto sales are giving a mixed signal while two-wheelers continue to remain on a strong footing.
Asta has been outperforming its peers.
RBL Bank and Bajaj Finance have decided to stop the issuance of new co-branded credit cards.
Flattish start, 24,140, neither here nor there.
Just about everyone is expecting a February cut, except Sonal, who thinks that it should be advanced.
Brokerages across the board have slashed their FY25 GDP targets for the country.
Absolutely flat on the benchmark indices, though the broader markets are very active.
A sharp drop in the market share for Ola Electric against the last one, that is against October 2024.
What is the Sierra? It is that part of your deposits which you cannot lend.
Some recovery from the lows in the Nifty. It's up 27 points and building onto those gains as well.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, it is a smart bounce back. Markets are forward-looking. They're not backward-looking creatures. That was a message, and I think that message is very well taken. 24,264 on the Nifty, and we're about 0.5% higher. This is Closing Bull. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Surabhi in the studios. Nigel is joining in from the newsroom floor. Guys, hi, good afternoon.
Hi, good afternoon, folks. So I guess, yeah, that's what it is, right? We were discussing and debating this in the morning, that the economy is weak, but are we completely shocked to hear that? Maybe not. And I think the markets moved on to hope and expect that at some point the RBI will relent.
Well, I think, I think that's the clear message, right? That this data is backward-looking, in fact. And now what it does is it calls on the regulators, it calls the government. Well, guys, it's over to you. You need to pep up things, and hopefully the second half of the year then shapes up. And I think that was the consensus earlier this morning as well. So the dips got bought into today. But I think we need to get past the 24,400 to see a more meaningful follow-through. But who's complaining? First 2 days of the December series have gone to the bulls, and things looking pretty good.
Absolutely. And, you know, it's a decent bounce. And let's hope that this week is better than the last one. Because, I mean, if you remember, last week also, that Monday was that Maharashtra election gap. And then, of course, I mean, Wednesday, Thursday, Friday turned out to be slightly more sobering. One just hopes as we get into this December, seasonality, etc. I mean, you know, there are all those things which are tailwinds, and you know, they work. So it's a smart bounce back from early lows. The market didn't spend very much time in the red early on. I mean, the dip got bought, and we've not really looked back since. So the first resistance is basically the highs that we saw last week, 24,350 or so, which is last week highest point. Unsuccessful attempts there, and then, you know, 4 days out of 5 we got to it and then sold off, so not very far again from that. Bank Nifty resistance at about 52,760. Again, that is the recent high for that index. That is also about 1.5% away on that one. Midcap, small cap indices, you know, they were the real outperformers, right? I mean, the midcap index last week, Friday to Friday, was up 2.5%. Small cap index last week, Friday to Friday, was up 5%. And those indices are continuing their outperformance. So nearly about 1% gain in the small cap index this morning. Sectorally, real estate, autos, and IT are the three areas where there is sort of, you know, between what, 0.5%, 0.75% to about 1% kind of gains. Real estate really is the pack which is doing the best out of those three as well. Rima.
Well, Asia also ended pretty smartly. So Nikkei was up nearly 0.8%. Hang Seng was up a little more than 0.5%. Shanghai was up nearly 1%. So Asia largely closed in the green. Europe, though, has started trade on the back foot. The CAC currently is down close to about 0.8 of a percentage point. Running you through the big winners, at least on the large cap screen, you've got Ultratech Cement right on top. It's a 4.5% gain. Grasim, so cement on the whole is higher today on expectation that the government capex will now pick up with the low GDP print. So now maybe the onus is on the government now to do the heavy lifting from here on. Outside of that, Apollo Hospitals is higher. Remember, there's been a big deal in the hospital space with Aster DM and Care. So Apollo Hospitals is seeing some bit of a rub-off. We spoke about Grasim, Shriram Finance, JSW Steel make it to the winners list with a 2.5% up move. And then in the bracket of 1.5 to 2%, you've got Tech Mahindra, M&M, Adani Ports, Titan and Dr. Reddy's. On the way down, life insurance companies continue to struggle. HDFC Life, SBI Life are under pressure. Cipla, NTPC, SBI Life. On Cipla, remember, there is a supply overhang. So that's, hurting Cipla with a 1.5% cut. And then you've got a few financials like Innocent Bank and Kotak Mahindra Bank, which is why, despite the Nifty and the Sensex being up close to about 0.6%, the Nifty Bank is on the flatter side.
Okay, well, on the global screens, Asia, yes, has had a good close, but let's see. Some of the Western markets are a little jittery right now. Europe is seeing a little bit of red. For instance, the French market, that's down about 0.8% right now, the French CAC. Hong Kong and Taiwan, our regional markets closed very nicely. And by the way, we had great PMI numbers from China. Smart recovery in manufacturing numbers, both the private sector survey as well as the official PMI that came through. So that worked well for the Hong Kong market. But anyway, the futures on Wall Street, now that Wall Street is going to be back post the Thanksgiving holiday in a full way, right now they're suggesting a bit of caution. So let's see how this goes. But hey, for us here, the mid-cap screen is looking even better. 0.7% of an increase on the mid-cap screen. And there are lots of names. We'll talk about Dixon as we go forward. That stock's been building on gains. Look at Happiest Minds right now. Definitely happy. Shareholders will be 6-7% up on Happiest Minds. There is IRB, a company whose fortunes are closely linked, obviously, to the state of the economy in Maharashtra. IRB is also finding lots of takers. Big move right now in the last couple of minutes and good volumes on IRB as well. So the mid-cap party is well and truly on, Nigel.
Well, that's right. Looking at the FASTag toll collections, that in fact has increased by around 2.7% on a month-on-month basis. So that could be a sign that there is some recovery that we're seeing on ground as well. I'm just looking at that data. I think it comes on the RBI. So you take the average daily volume, that's moved up. Even volume in terms of number of transactions as well, that is up by 7.5% on a month-on-month basis. So a recovery on a month-on-month basis is definitely encouraging. I'm talking about data for the month of November. The FASTag toll collections, that's a good sign, I think so. But getting back to other stocks that we are looking at, well, Reliance Industries, that was the one that has been a bit of a drag in the last 6 months or so. Now, in the last few trading sessions, it's actually been leading. Reliance Industries, even in today's trading session, it's higher. It made a low, if I'm not mistaken, of around 1,215. And it's gradually recovered from there. And now it's holding above the 20 DMA. So that's a good sign. I think the next level you're looking at is around the 50 DMA, which comes in at around 1,355. So keep an eye out on that level. Home First, that was a stock that I had said that we should be tracking from the morning. For the last 1 month, the stock had lost close to around 8-9% of its total market cap. Today, there was a large trade that took place. And from the lows of the day, Home First Finance as well has seen a big recovery because the street was anticipating that this large trade of around 15% from the promoter entity will get out of the way. So the intraday chart on that one comes up for you. Mitesh Thakkar, though, is back with us. Well, Mitesh, what do? The Nifty is up close to under 150 points. The mid-cap index as well, after underperforming, that's now up close to under 100 points. Any trade on either of these two frontline indices?
On the index, Nifty, I would still want to see the index get past 24,350 because now if you go long, I think the risk reward is not favorable. In the morning, I was not very sure whether I want to go long or not. So we're trading with long bias on stocks, and I think that's the way we're approaching it. It partly covers up for the Nifty because most of the large caps are participating in the rally today. And in that sense, I think, the Nifty, as I said, I would want to buy only once we see the index stabilize about 24,350. For the timing, I have a buy on OFSS, which I would recommend buying with a stop below 11,950 for targets of 12,750. And the other one is IRB. I think you were just discussing the stock. It's given a good breakout. So buy here with a stop at 53.25 for targets of 59.
Okay, those are some ideas. MapmyIndia is another stock which is in focus. The stock is down 3.5%. And the news here is that the promoters of MapmyIndia, Rohan Verma, who's currently the CEO of the company, he's floating a new venture which will focus on the retail side of the business. He personally will own 90%, but MapmyIndia, the listed entity, will hold 10% in this new entity. And there's also going to be some sharing of the brand Mapples between the two. And MapmyIndia has committed to buying the 10% stake in the new venture for about 35 crore rupees by subscribing to the CCDs. Dipan, so there are always... Yeah, come in.
Reema, I just had a question on this. I mean, clearly the market's concerned because it's the promoter which is getting into another business. And
I mean, it's a linked business, right?
That's what I was asking.
Is it B2B?
Correct.
And now they want to focus on B2B2C.
Yeah, but the fact is that it's not happened through the listed entity itself. It's in a very indirect way, but the listed entity is only going to take 10% exposure to this B2C business. So yeah, we probably need more clarity.
So one way to, I mean, there are always concerns on related party transactions, right? Between the two entities. The company said that it's been done very fairly at an arm's length, etc. But the other way, maybe why they're looking at doing this separately, is because a B2C business is also very capital intensive. You have to acquire subscribers, you end up paying. So you don't want that money to come out of the listed entity. So that could be the reason why maybe they're deciding to do it separately. But there is an investor call today at 5 p.m. and we will get greater clarity. But Dipan, come in with your views on MapmyIndia.
Yeah, Nima, good afternoon and thank you for having me on your show. But first, a disclosure that we own shares of MapmyIndia.
So perfect. You're the right person to tell us. As a shareholder, what have you made of it?
I've been owning since IPO days. Okay, and very disappointed with the performance of the company. It's a company which has really just not lived up to its full potential. I'm a great fan of platform companies and in terms of what they have, the asset which they have in terms of the database, I don't think they've been able to utilize it and exploit it fully. Maybe they have a big, strong competition coming in from Google Maps, which is why they have not been able to live up to their full potential. And now this, particular development, I don't understand because MapmyIndia has got adequate cash on its books, and this is clearly going to be conflict of interest. Even if they have to invest in a retail venture which is going to burn cash, the way the companies are doing it, they're reporting the cash burn separately, and the valuations are then therefore remaining intact. The best example is InfoEdge, which is burning cash on some of the other portals, but is making a lot of money on Naukri.com. So I don't understand the logic. And there's going to be in terms of mind space of the promoter being going to another entity in which they are the major beneficiaries of 90%. So whatever the management logic they may give, I'm not accepting it. I think it's not a great development. And certainly we are going to be reviewing our investment in the company.
Okay, all right. Got that. Deepan, so that's a word on MapmyIndia. Stock has been in sharp focus today. Deepan, the other one that we were just discussing, we're talking technicals with Mitesh as well on IRB. Obviously, IRB is very closely linked to whatever's happening in Maharashtra, and Nigel was pointing out the toll collection data as well. To be honest, toll collections have been fairly okay last couple of months as well. Your thoughts on the stock?
I think we're very positive on infra companies. Only thing is IRB's track record requires a lot to be desired. And maybe there are better plays also on infrastructure construction. Prefer companies like ITD Cementation, which have been acquired by Adani, even PSP projects, company in a similar situation. And from a disclosure point of view, of course, you have investments in both. But you have to have L&T in your portfolio as part of your core holding. So my preference is more for such companies than IRB, because at the end of the day, IRB has got a lot of it has a construction business, but also has a kind of annuity type of business, which I don't think adequate growth would be there over there. So I'd give a pass in IRB, but the sector as a whole certainly has a lot of potential.
Got that. Now time for a couple of more insurance stories, right? The government has proposed amendments to the Insurance Act that would allow agents to partner with multiple insurers across life, general and health insurance segments. What does this mean? The implications, especially for somebody like LIC, which sells most of its policies through its agents. That's the bread and butter for LIC. And what will this mean? Yash, take it away.
Well, Prashant, as you rightly pointed out, very interesting takeaway from the amendments which the government has proposed as far as the Insurance Act is concerned. Open architecture for individual agents is one of those particular proposals. As far as what that means is essentially allowing individual agents to tie up with more than one life, one general and one standalone health insurance company versus the current regulations where individual agents can only tie up with one life, one general and one standalone health insurance company. This, as you rightly pointed out, on the face of it is negative for the largest life insurance company, that is LIC. LIC has the largest agent force as far as the whole insurance sector is concerned. More than 50% of that as far as market share is concerned out of individual agents stands with LIC. More than 96% of the business which LIC gets comes from individual agents, and if these agents are allowed to tie up with more than one life insurance company, that is LIC, then certainly there could be some distribution of agents away from LIC and to various other private life insurance companies in a situation where a largest part of business for LIC comes from these individual agents.
Basically, the LIC policies are now will be, if these are passed, will be they can sort of sell other life insurance policies as well, other companies' policies as well. That's the LIC stock. I mean, it's been it's had it tough over the last many months now. Just one more stock, Yash, Max Financial is a stock we're focusing on. Let me tell you the backdrop. The government, as part of those amendment proposals, has suggested allowing merger transfer of business between an insurance company and a non-insurer. And this will be up to the IRDAI, the regulator, to approve or disapprove. So far, it was not allowed. I mean, merger transfer of business was only allowed between a pure play insurance and between two pure play insurance companies. Now, non-insurer or insurer can come together. Yash, tell us more.
Well, Prashant, another interesting takeaway from the same set of amendments which the government has proposed. As you said, so far, the Section 35 of Insurance Act only allowed merger between two pure play insurance companies, and an insurance company was not allowed to be merged with a non-insurance company. We saw the old, about 7-8 years ago, HDFC Life, Max Life and Max Financial merger being declined for the same reason, because of the same Section 35. But as a part of the new proposals, the government has sort of put on table this particular idea of allowing mergers or transfer of business between an insurance company and a non-insurance company. The reason why this is important for Max Financial Services is that Max Financial Services is the holding company of Max Life Insurance, and Max Life Insurance in the past has expressed the intention, for the purpose of simplification of corporate structure, to merge Max Financial Services, the listed entity, into Max Life Insurance. With the government putting this as a proposal and stakeholder views being expected on this particular proposal, if it goes through, that plan of Max Life and Max Financial Services will get a go-ahead from the government. Of course, finally, as far as the regulatory approval is concerned, will depend on the insurance regulator, that is IRDAI.
Right, Yash, thank you very much for that. So, two interesting bits of proposals. Let's go across to Deepan. Deepan, you heard Yash. Any thoughts? I think you do own LIC in your portfolio. Correct me if I'm wrong. And then, of course, I mean, there is Max. Go on.
Yeah, that's true. But, I look at the brighter side, and LIC can also look at the agents of other insurance companies to sell their LIC products as well. End of the day, access is not a problem. All the products are available either through this agent or through the other. And a lot of business is also going online. It's just the quality of the service, the structure of the product, the reach, the returns which they have given. I think all of these things matter much more. And most important, valuation point of view, LIC just now trades at about 70% or thereabout of its enterprise value or adjusted enterprise value. And that's as compared to 2 times to 4 times for private insurance companies. And that gap, I think, certainly provides an opportunity from investors' point of view to get slightly higher returns. And this asset value of LIC is increasing because of the kind of bull run which we have seen in a lot of their stocks as well. So from that point of view, remain very positive on LIC. And look, these are proposals. Let's see how it actually plays out, and implementation and long-term effect are something else to think about.
Okay, all right. Deepan, I wanted to ask you about the cement pack. You've not been a fan of cement, I know. But now, suddenly, for the second half of the year, there is some positive commentary that's coming about. Are you part of that camp which believes that things will turn around from here on pricing, on demand, raw material costs as it is soft? Or are you in the camp which Anil Singhvi, he joined us earlier today of Sri Digvijay Cement, and he's been a veteran of the space. He says he's still to see signs on the ground that things are actually improving. and he didn't sound so positive. Do you want to change the camp, or are you sticking to that cautious view?
No, I think that Anil Singhvi spoke what I couldn't say, and he's absolute guru in this industry. And he calls a spade a spade. I think if the industry realizes that there's a problem, they can do something about it. But being in denial that it's a temporary slowdown and the kind of capacities coming up will not affect capacity utilization going forward, I think all of this is going to cause a lot of damage from a long-term investor point of view. So there are issues at the ground level for cement companies. I did not know that cement prices were 10% down, and after so many years, he says that there could be negative growth rates for cement. So there's something for investors to think about when they're investing in cement companies. And I maintain that these are very mature industries, and you can trade in them from time to time if you get the cycle right. But they're not going to be great wealth creators going forward. And this madness in the industry, just keep on adding capacity at any cost or acquiring companies at any valuation, that certainly is going to impact the returns from an investor's perspective.
Okay, so cement, quite some excitement today in the market in terms of the stock price movement. Let's actually look at one more important story that's coming in from New Delhi. The government has decided to scrap windfall tax on ATF, on crude products, petrol, diesel exports as well. We have Tim C joining in with all the details. Tim C, fill us in.
Well, we told you first, and now it is confirmed that after being in existence for almost over 2 years, the government on 2nd December decided to withdraw the windfall gains tax, which was levied on exports of crude oil, ATF, petrol and diesel with immediate effect. The levy was, remember, introduced on 1st of July 2022. So far, it has yielded government about 44,000 crore rupees of revenues. But since in the current fiscal, the revenues were slipping and not yielding much, the government on industry demand decided to hold a detailed review of the tax to assess whether it should be continued or not. In the first year of the levy, government had collected around 25,000 crore rupees from this, and in the next fiscal, that was FY24, the collection slipped to almost half at 13,000 crore rupees, which further declined to 6,000 crore rupees in the current fiscal till 1st of December. Because most of the time, after the fortnightly review, the levies were at nil. Just to give a background to what happened and why this decision was taken, sources have told CNBC-TV18 that the Prime Minister's office, on the request of the industry, took a detailed review of the levy with the officials of the Revenue Department and the Petroleum Ministry earlier in November. During the review, it noted the challenges faced by the industry, the impact of the levy that it was having on the production levels, and the quantum of revenues the government was getting from this tax. Post which, sources said that the PMO decided that the levy should be discontinued since industry was unhappy and wanted the government to not to continue with the tax, as the average crude prices were also in a comfortable range, and secondly, the revenues were not much. So that happened, that was the background, and today finally government announced, it came out with a notification that from 2nd December with immediate effect, the levy should be discontinued. That's what happened at the back, and today the decision has formally come, which we reported on 18th of November. Back to you.
All right, Tim C, well, congratulations. You got it ahead of the curve there. Thanks for joining in. So windfall tax is a thing of the past for things like ETF, crude products, etc. Deepan, I remember when it was first introduced, obviously it was a big market negative. Any new tax is disliked by the market. But then the market kind of got used to living with it, right? The stocks would not even react on these fortnightly reviews, small tinkering in tax, depending on how crude prices were moving. Now, is this removal any fresh trigger? And even if it isn't, how do you look at some of the oil and gas plays? Is there anything you like here?
I don't think it's going to make much of a difference, but it's just that it's a threat. It's been withdrawn just now, but whenever they start making super profits in future, it can always be reintroduced. So it remains like a dangling sword on the industry. But more importantly, I read about this sales of EVs in China, and now 1 in 2 cars sold in China is an electric vehicle, and that's going to have a really long-term impact on petrol consumption, and therefore going to impact refined products as well as crude oil demand as well. And if it's going to impact refined products, then that's going to have a negative effect on Reliance Industries, some of the other standalone refiners, and to an extent even on the oil marketing companies. So this entire space of oil and gas, one needs to be a bit circumspect. And I'm not sure that this is a great growth industry. Sure, stocks are cheap over there, no denying that they have been so for decades. But you can trade in them, but I wouldn't hold them from a long-term perspective.
Okay, all right. Deepan, we'll leave it on that note for this morning, this afternoon. Thank you so much for joining in, and we look forward to another conversation soon. Well, we need to take a quick break on that note. Come back on the other side, and we will be in conversation with Pashupati Advani. We'll get some more perspective on the market.
Okay, welcome back. 135 points higher on the Nifty, 24,265, holding steady. Pashupati Advani from Global Foray is now joining us. Pashupati, good afternoon. Good to have you with us here. Thank you very much for your time. I don't know if you own any insurance stocks, but one after the other over the last 2 weeks or so, we've reported on some 3-4 stories. Our colleague Yash was talking about the story, and a lot of this is now focused on sort of, changing how distribution of insurance products is done. Earlier, till now, till about a month, 2 months back, all the regulation was focused on products themselves. Now it's all distribution. So there is a bit of a shake-up happening in the industry. Just your thoughts here. Pashupati, if you've looked at these stories, you've heard Yash, go on.
Obviously, the government wants insurance to be in everyone's hands. And then the investment from that insurance has to come back into the markets, both fixed income as well as equity. So that's a win-win from the government's perspective. You're mentioning LIC. I've been in and out of it, but it's been a bit of a disappointment because it was up at 1100 plus, and now it's back to 3 figures. So it's a little bit disappointing because I guess people feel that they'll lose market share to the newer players. But at the end of it all, I think the general idea is that government wants insurance to go to the next tier of people, and hopefully, there's also talk about the Income Tax Act getting rewritten and with some things like that. So under the current act, if you're in the new system, you don't get any incentive for owning insurance. Maybe with the new act, it'll come back, because that's what I've been told. So again, that'll bring a boost back to the insurance companies, and that'll make them start writing policies again. Prashant?
Hi, Pashupati. Thoughts on Cipla and this stake sale that we're seeing today by the promoters?
Well, the promoters of Cipla, they've been very solid, but there aren't, the eldest promoter doesn't have any kids. So I think that, they want to try and start a family office. They've always been good about giving money away. I think Mr. Hamid Senior may have actually signed the giving pledge. So I think part of that is, to now give back to the public with real money. So I'm not surprised to see it. And, it is a company that's doing well, so why not? And hopefully one of the other pharma companies may come in and buy the whole thing at some point. It's possible.
Hi, Mr. Advani. Good afternoon. Good to see you. I believe that you're positive on cement as well. We have Deepan, who's not very, very comfortable with it. And Mr. Anil Singhvi, who joined us earlier today, and he was saying that things are not yet picking up, though he remains hopeful. So tell us, what do you like in cement? Point number one. And on this pharma point, you're liking a couple of companies, chemical companies that supply pharmaceuticals. So tell us about that as well, if you could name a couple of stocks.
Well, so let me talk about cement first. First of all, the cement part, government is, hell-bent on continuing their infrastructure. They may have slowed down a little bit, waiting for a little bit of a breather. But, today's prices means there's something coming with the cement industry, because all of them are up. So I think some sop is coming for them, or maybe the government's going to give more orders or something like that. But, we do need to complete roads. We've got a lot of infrastructure spending going on with the metros, housing, so there is demand. And the reality is that, we are making, we are using. So the thing is that it's all very, great, but it'll continue to be used. So I think that that's one of the reasons why cement companies are continuing to do well. So that's number one. You mentioned about pharmaceuticals. That sector has really been a little whacked around a little bit, and people have been very unhappy with it. But I think that there is fundamentally a lot of strength in the pharmaceutical sectors. But some of the companies have actually done downstream and have bought some of the companies that supply to them, and I think those are the ones that are a little more interesting. I would, again, if I was coming into the market and I wanted to look at pharma sector, I would go for the big ones like Dr. Reddy's, maybe like Cipla also. I think those are the companies that continue. Sun Pharma. So just stay with the good ones, and I think that'll pay off because we are the pharma capital of the world, if you want to call it. The world may not think that way, but I think we do. We are.
Okay, so pharma is a space to look at. By the way, before Pashupati, hi. Before I ask my question, let me just allow to quickly check what's happening in money markets today in India and around the world. For context for our viewers, the China 10-year bond yield today has collapsed to less than 2%. Because there's a growing expectation that things are so dire in China that at some point there has to be just straight out more monetary stimulus as well. Let's see whether that happens or not. That's the dollar yen. Now pull up dollar rupee. Let's come back home. We have other issues here at home. The rupee has weakened beyond. I mean, it's almost now we're talking, I think, almost touching 70. Yeah, there we go. 84.70 on the dollar rupee. So that's a 0.25% move just today itself. And when we talk about the bond is interesting because the bond yield hasn't moved too much today because the market is saying, how will the RBI cut on Friday with inflation running over 6%? So that's a bit of a conundrum in terms of the money market sort of moves out there. So, Pashupati, hi. Now, this brings me back to the larger question, this whole piece of how the Indian economy is slowing down. And we've heard that corporates have said it, now the GDP number is saying it, etc. Now, are you betting on some sort of a stimulus, either fiscal or some kind of anti-dumping duty action, some tariff action, or maybe monetary action? And if yes, then in terms of stocks, how would you play it? Like you've liked infrastructure in the past. You've, I think, also been more optimistic on PSUs after the correction. So then what next? Because it's very complex now, the whole landscape.
So my read of this is that you've basically got a situation where the government has to continue to stimulate. I'm not seeing the kind of private sector investment that should match. I mean, there is some. It was zero a while ago. Now there is some. But I think that at the end of it all, we're not seeing the private sector jumping in. So the government has to keep spending and basically keep funding it. So I think that's very important. And if it means that they have to take on more debt, so be it. I don't think rates are going to come down too much. I think if at all, it's just a whim. And the other thing is that, with what's happening in America, I think a lot of money is looking to go back, back into America because America looks like it's going to be interesting. America looks like they're going to put up some kind of tariffs which are going to make it good for American second-tier manufacturing to be a nice place to be. And Trump is basically warning everybody that if you don't run your world the way we want you to run it, we're going to cut you out. And then I don't know what's going to happen, but he's capable of actually. The thing is, he's doing what he's saying he was going to do, and people didn't think he was going to be able to get away with it. But I think that it looks like he is going to be able to do it. So, he's trying to stop the wars. He's trying to, tell people you cannot have a new currency that's going to take on the dollar. He's going to put China in the box. He's going to put Russia back on the box. So, I think a lot of things are going to happen come January. So
absolutely, we'll have to see what those executive orders look like when they finally start getting signed into policy and law. American exceptionalism, as they call it, right? So Russell 2000 is already up 10% in the last 1 month. We were looking at data in the morning. Anyway, now coming to stocks. So because of this complexity, would you rather stick to, you named pharma? I don't know, would you look at some defensive names like maybe IT or something? Or would you still look at some capex plays? Any fresh names that have come to mind? See, I'm very uncomfortable with the IT sector simply because I think that with artificial intelligence, the game is being rewritten. And I don't know if our companies with their hundreds of thousands of employees are able to write the games as fast. If we can, it'll be fantastic. If not, I think we're going to have all sorts of issues. However, we've got a very strong domestic market. And I think that's what's driving. So people are buying white goods. People are buying, FMCG is okay, but then, people are buying food and things like that. So I think that, it is one of those things that our domestic economy is going to drive any company that's domestically driven. But we can't be in a cloud. We can't be sitting out there and not be affected by what's going on. And at the end of it all, our market is driven by money flows in and out. And at the moment, I'm seeing money flows going out rather than coming in. That's just my perception. I may be wrong, but that's what I'm seeing. Despite the fact that we've added some bonds, our bonds have come into the index. Besides this, but we're having IPOs. We're having big IPOs coming through. And LIC is also looking to sell some stake as well. So let's see what happens.
Okay, all right, Pashupati, we'll leave it there. Thank you very much for joining us. Great speaking with you. It's a pleasure having you here on CNBC TV18. It's 3:05, so we'll take a quick commercial break here. We're going to come back and we go across to Nimish on the other side for all the buzz in the dealing rooms and all the stocks where there is news flow one way or the other. So that's coming up. And of course, after that, we'll get you our buy today, sell tomorrow trading calls as well. Stay tuned.
Welcome back. Keep an eye out on a few stocks. Honeywell is a stock that was trading in the red. That's moved into the green. Volume's not very, very high, but that one, in fact, has done a bit of a U-turn. And Chola Investments is another stock. Volumes are high out there. And that one, as we speak, has moved to the high point of the day. So both those two stocks should come up for you on the screen. But it's a good time to get in, Nimish. Well, Nimish, it's been a good trading session. The market seemed to have shrugged off this GDP data, and they're saying we're looking ahead. We expect things to improve from here on. But how are the flows? How do you read the current market dynamics?
Well, actually, a good-looking screen, a good recovery as well, intraday from the lows, and it looks like there is decent buying as well, is what I understand from larger FIs. So again, the buy-sell ratio is close to 3:1, which is very, very positive, and that actually rubs off into the broader market stocks as well. Within sectors, cement has done well. You explained in the link as well. There is an expectation of a price hike across the board from cement players, and also real estate names have done well in today's market from a flow perspective. So that's the overall feedback. I think the broader market index has been buzzing, and also because of the new F&O entrants. There is a lot of traction in the new F&O stocks, even from a trading perspective from the retail investors, is what I understand, as far as flows are concerned. I guess from a direction point of view or from a trigger point of view, the RBI policy on SEX will be very crucial. Lata explained as to why there is an expectation of some liquidity ease that could be positive. And also remember, the change of guard at RBI is something to watch out for, right? The Shashikanta Das, the tenure ends on December 10. So, of course, a renewal would be seen positive. So that's a big trigger to watch out for. But broadly, today's recovery looks like it's backed by a very decent FI buying.
Well, that's going to be interesting. Then we'll get that data point by around 6 p.m. later today. But what about individual stocks?
Well, so in terms of individual names, the first stock is Heikel. The entire CDMO space off late is done well, but Heikel stands out on very large volumes. The stock is up 10%. And I understand a leading family office recently bought a stake in the company, and hence a big excitement on that particular name. The second stock is Bharat Forge. Even that's been buzzing off late. There are buy flows, is what I understand from larger FIs today. Also, the city is anticipating a large order win in the defense space for Bharat Forge. And also, there could be a potential QIP on the cards as far as fundraising is concerned. The third name is Hoodco. Within the PSU names, a new entrant in the F&O space. Well, the stock is subdued today, but there are buy flows, is what I understand. And leading domestic mutual fund has been an active buyer of late in Hoodco. So that's the third name. The last is IGL. Well, we saw Gujarat Gas hiking prices today, but IGL has been buzzing since the last couple of days. Looks like the selling pressure from a leading FI is largely over. And also in IGL, for city gas companies, anyway, there are reports of they're getting added to the in the next GST Council meet into the GST. So that's a trigger. But additionally, the buzz is that maybe some relief could be on the cards for all the city gas companies as far as pricing is concerned. So that's the reason why IGL is buzzing in trade today.
Okay, thank you very much for that, Nimesh. That's IGL, MGL, IGL in particular that he spoke about, and these stocks are higher in trade. Now, Mitesh is back with us for a few BTST calls or reverse trades. Mitesh.
Yeah. So Reliance, I think, after a long time is showing traction on the upside. I would suggest a BTST there with a stop at 1302. target of 13, 20, 25 zone can be looked at. And once it clears those levels, then I think I'm looking at a stronger up move. That's one. And the other one is JSW Steel, which is also closing strongly. So BTST here with the stop at about 982 for targets of 1,000 to about 1,005.
Okay, all right, got that. Mitesh, thank you very much. You have a good rest of the day, and we will connect tomorrow morning once again. Now, let's go back to, looking at a couple of these electronics manufacturing companies, because many of these stocks have been buzzing around. Dixon, of course, has the added news flow surrounding their tie-up to make Pixel phones here in India. Look at that, stock's up 6%. But there are other buzzers as well. Upasana is joining in. Upasana, what exactly is this note saying, and what's the bull case here?
Well, Surbhi, according to the media reports, cabinet approval is likely around 40,000 crores in electronic component manufacturing scheme. And Nomura believes if approved, the outlay is sizable, and this would replace the erstwhile SPECS scheme, which ended on March 2024 with an outlay of just about 3,200 crores. Now, government targets to increase the local value addition from 15 to 18% to 35 to 40% over a period of 5 years starting from April 2025. Nomura believes this scheme can see strong response from Indian players, and companies such as Dixon, Keynes and Samvardhana Motherson have already announced plans to capitalize on this. Of the components, display contributes almost about 10 to 20%, followed by camera, battery modules and mechanics. Now, coming firstly to display, now Dixon has already announced that its plant will commence production from Q2 FY26 in displays with a revenue of 1,100 crores in the first fiscal, and it will potentially scale up in the upcoming years. Now, Samvardhan Motherson has also announced that its display plant has started operations from Q3 FY25 with a bigger scale up and targets 7 to 8,000 crore revenue from FY27 onwards. Hence, overall, looking at the market dynamics, Nomura believes that it expects more tie-ups in the component space in FY26, which will certainly benefit from this scheme that the government is planning to approve upon. And overall, it has maintained a buy rating with a target price of 18,654 on Dixon, and it has given a buy rating on Keynes with a target price of 6,516.
Okay, all right, got it. Thank you very much for that, Upasana. So that is the latest in terms of what the EMS space is expecting in terms of fresh policy impetus. We'll take a break on that note, come back with a little more on the markets in just a bit. We'll be on the final leg, and we will also go back and discuss what the CNBC-TV18 MPC makes of the RBI expectations come Friday. Welcome back. What will the RBI do? That is the predominant question that has been on the market's mind, both the equity and the fixed income markets. The rupee market have their own story to tell, obviously, because of all the rhetoric, quote-unquote, sort of commentary we've heard from President Trump over the weekend. But, of course, we have Lata joining in. She was sitting down with a bunch of experts for the CNBC-TV18 Citizens Monetary Policy Committee meeting. So, Lata, what is the takeaway? Any cut, any softness, any more liquidity or help?
Yes, it's a mock MPC, I would like to think, and it's fairly representative of the market's opinion and the expert opinion. There are quite a few people who are not trading a book, so, it's an academic opinion as well. Now, the key takeaway, a pause on rate hikes. So they're not expecting a pause on rate cuts. You won't get any action except for 1%. So 4:1. No change in rates. Sonal Verma was the one who dissented. She was voting for a cut even in October. On CRR, the majority expect a tinkering of the CRR. 3:2 majority. The others also say that liquidity will be provided, but only by other means. Like, the RBI can buy bonds, or they can use the VRR, the repo rate, variable repo rate. But they are all expecting liquidity to be provided. All of them expect a rate cut by February. All except one, the one person who's already expecting it in December. So it's only a question of waiting for 2 months. All of them expect inflation to be marked up. One number I got was 4.8, but the average I got from the street also is around 4.8. All expect growth to be marked down. I didn't take a poll there, but the poll that I did take said that it would come down to 6.3. the growth, but 6.5 is where the RBI may itself put it. The street expectations are more like 6.3. RBI probably will bring it down to 6.5. Now, I'll tell you the main reason, which is very convincing. At a time when liquidity is not adequate, even if you give a rate cut, banks can't pass it on. They will pass it on to that external benchmark linked products like home loan and corporate loan. But for a better part, auto loans and all, they will not, because they're still borrowing. Their raw material is expensive, deposits. So they will not pass it on. But the other way around, if you do a CRR cut, every time I give a loan, I actually make a deposit in your favor. And then I have to keep, instead of 4.5, if I keep only 4% idle, then that extra money, I give it to you in your cost. So when you do a liquidity injection, immediately, the products gets cheaper. So their point is that if you want to drive credit growth or fuel the economy, this is the easier thing to do. It's very difficult when your last number was 6.2. It's not even that. You can argue that as the lagged number. But you have to increase the inflation forecast. How can you increase inflation forecast and say I'm cutting rates? So they expect it to be tough now, but easier in February. But let me tell you, there is still a niggling worry in the market, not in my MPC, that a repo rate cut can come.
Because things are looking a little more dire than...
who knows February what will happen? Maybe the Fed will stop cutting so that you will be faced with a more hawkish environment. So why are you assuming that it will be easier in February?
Why niggling worry though, Lata? I thought niggling...
People will be happy.
Positive, okay. Worry because you're not priced for it. Okay, sorry, wrong word. A niggling hope.
You know, considering, I was just looking at today's developments in China, considering our neighbors, now the bond yield has come down to less than 2%, China. And there's all this tariff hawkishness and action, and God knows what's upon us come January. And like you said, we don't know what the Fed will ultimately do. Perhaps will the RBI suddenly have a change of heart?
I mean, but China, Surabhi, for the longest time, yields have been sinking lower and lower because there's deflation. I mean, outright deflation. But
they are and also they're not investing in the equity markets. Everybody's running to some sort of a perceived safe haven, buying bonds. And that's just the
okay. So just quickly, what they key sentence from each of them. Soumya Kanti Ghosh of SBI said rate cut won't get passed on, and that is why it won't be done when liquidity is tight. He expects a 50 bips in February. Cut late but big. Samiran Chakrabarti says Q2 was too bad. We must not extrapolate it completely. The base effect of very high EBITDA margins for mining and metal companies vanishes in the third quarter. The base effect is not bad. So actually growth could look better. But the worry is like the pressure is there on the rupee. So they can't do much. Sajid was the one who was really worried. I mean, the global scenario is likely to be so confusing. Lower growth, probably higher inflation, probably even deflation. If China dumps because it can't sell in one country. So it's a very confusing scene. Sonal Verma's point that inflation is seen closer to 4 next year. So you don't have to look at this. Yes, I am increasing the forecast for FY25, but I am decreasing it for FY26 can be a reason enough. And finally, Dr. Pranab Sen saying that why are we alarmed? Growth has come back to its pre-COVID level. Our natural rate of growth is 6.5. If you thought it is 8, that's your problem.
8 sounds so much better than 6, right? Lata, thank you so much for that. Very quickly before the market closes, let's try and get in a stock market perspective on this in terms of what can you do. Any stocks to play? Anand Tandon is with us. Anand, sorry, I mean, it was a longer chat on the economy because of the way things are. But if there is some sort of stimulus coming, some easing from the RBI, bank stocks, what's the view? Is there anything else you will buy? Because the market is forward-looking, right? Look at today's screen itself. Anything else that you will buy anticipating more stimulus?
Well, it's forward-looking only from where we start. Because, if it was forward-looking, it would have been down a long time, about a quarter back, because it would have seen the slowdown. So it is, the reality is that the market is overpriced, continues to remain overpriced. There is no reason for the RBI to cut. Inflation is way out of whack and needs to be brought down. And therefore, we are talking about hope rather than a strategy about what is going to go forward. Banking remains an attractive position. By and large, it is one of the cheaper sectors to be in. So the short answer is, should you be investing in banking? Yes.
Although, Anand, the market did sell off, right? 10% from the highs, from the September highs.
Anticipating the slowdown.
Well, that is not anticipation. That is reaction to the results that came in, which were pretty bad.
Yeah, no. So what else are you doing, Anand, in terms of individual
Waiting for
ideas?
it to fall.
Waiting for what to fall?
For the market.
Everything, or has anything fallen enough?
In a short conversation, I can only talk about the index. I don't believe that we are at a fair price yet. We have to expect lower estimates for the earnings going forward. I think they have just started to get factored in. And even without a change, even if you assume a 5% reduction in the expected growth for the next year, you should at least get a commensurate fall, even if you assume that the valuation is correct, which in my view is not.
Okay, very quickly, your shopping list. Yes, you're waiting for the correction to continue maybe a little while longer. Beyond banks, what else is on the list?
Well, it will depend on what falls the most, right? And at the end of the day, right now, I think the only thing you are looking for is the lower level earnings. I mean, a lower level of consumption, which will grow up at the lower end. Right now, we have been driving premiumization, and that has been what has been the theme all along, until you get a more broad-based consumption growth. And that could be one of the factors that could drive the market, because you are expecting to get more money into the hands of rural India and so on, as more, policies of the government change to become a little more free in terms of distribution of money. That is therefore going to be the kind of area that you want to be in, lower end consumption, not the higher end.
Okay. All right, Anand, just allow us a minute to count down to the close. We are looking at a 145-point up move on the Nifty. So the bulls have managed to prevail. Looking at the glass is half full and not half empty today. Gainers include Ultratech Cement, big move on that stock, 4% higher. There's Apollo Hospitals, which is the next best performing stock on the Nifty, 3.5% higher. Grasim as well from the cement space, 3%. And then it's mixed. Shriram Finance, JSW Steel, Adani Ports, Mahindra & Mahindra, Tech Mahindra, Titan. So, I mean, Prashant, I guess a pretty widespread move today, and midcaps did even better.
Oh, yeah, midcaps did, much better. So it's a long list of, big volume-led gainers. Maybe, one space which did very well is a small space, market cap-wise, but paper, JK Paper, if you can have these up quickly, West Coast Paper, Star Paper, it usually does well as a pack or badly as a pack, and today it did well. There was Goldium, which was locked up 10%. That's the sort of artificial diamond company. Cosmo First, huge laggard, did well. Himmat Singh has been up since the morning. Ola continued a little bit of recovery and repair. Recent listing, Blackbuck was up 10% today. Nelco was up, limit up, I think, by close. Castrol had come off quite a bit from the highs. That did about 6-7%. There was Affle, Happiest Minds, and of course, the Dixons of the world, of course, we've been highlighting from the word go. And of course, the sector of the day, cement, as we've been highlighting through the course of today's session. Well, it's a wrap on this edition of Closing Bell, but do stay tuned. Markets Forward is coming up to take forward all the action. Stay tuned.